What happens when every major resistance level gets obliterated in a matter of weeks? When the technical charts that traders have relied on for years suddenly become meaningless because there's nothing left to stop the momentum. That's exactly where we are with gold right now, and what I'm about to show you is going to fundamentally change how you think about what's coming next. Look, I've been analyzing precious metals markets for years, and I can tell you with absolute certainty that what we're witnessing right now is not normal price action. This is the kind of setup that only happens once or twice in a generation. The kind of setup that creates generational wealth for those who understand what's happening, and devastating losses for those who don't. Let me paint you a picture of what's actually going on behind the scenes. Gold has systematically taken out every single technical resistance level that analysts have been watching. We're talking about levels that held for months, sometimes years. Levels where institutional traders had placed massive sell orders, expecting the price to turn around. And one by one, those levels have been shattered like glass. The 3-week high that everyone was watching, gone. The psychological barriers that typically cause hesitation, blown through without even a pause. And here's what's really fascinating. The relative strength index, that key momentum indicator that technical traders live and die by, has recaptured the 50 level on the daily chart. Now, for those of you who don't speak technical analysis fluently, let me translate what that means. When the RSI crosses back above 50 after a period of consolidation, it's essentially the market's way of saying the bulls are back in control and they're not messing around. But here's where it gets really interesting, and this is where most analysts are missing the bigger picture. This isn't just about technical levels on a chart. This is about a fundamental shift in how the world's largest institutions are viewing gold as an asset class. Think about it. Who has the power to push through resistance levels that have held for weeks or months? It's not retail investors buying a few ounces here and there. It's not even wealthy individuals adding to their positions. We're talking about central banks, sovereign wealth funds, and institutional players moving billions of dollars at a time. And they're doing it for a reason that should terrify anyone who's sitting entirely in traditional paper assets. Let me take you back to a conversation I had with a former central bank trader. This was someone who spent decades executing gold purchases for a major European central bank. And he told me something that stuck with me. He said, when you see gold breaking through resistance with this kind of conviction, it's not speculation, it's preparation. Preparation for what exactly? Well, let's connect some dots that the mainstream financial media conveniently ignores. Right now, we're living through the most aggressive de-dollarization movement in modern history. Countries that have relied on the US dollar for international trade for decades are actively seeking alternatives. The BRICS nations aren't just talking about creating a new currency anymore. They're implementing actual trade agreements that bypass the dollar entirely. Quick aside here, because this is important. If you're watching this and you have retirement savings sitting in traditional accounts, I put together a free guide that breaks down exactly what thousands of American retirees are doing right now to protect their wealth from what's coming. It's in the description below. No fluff, just the actual strategies that are working. Worth checking out while you're thinking about this. Now back to what's happening with gold. When major resistance levels fall, it creates what traders call a vacuum above the market. Think of it like this. Imagine you're climbing a mountain, and there are rest stops every 1,000 feet, where climbers typically pause, catch their breath, maybe turn around. But what if you reached a point where there were no more rest stops, where the path ahead was completely clear, with nothing to slow you down? That's the technical setup we're looking at right now. But let me dig deeper into why this is happening now, because timing is everything in markets. The Federal Reserve has painted itself into a corner that most people don't fully understand. They've got inflation that's still running hot despite all their rhetoric about having it under control. They've got a banking system that's more fragile than it's been since the financial crisis. And they've got political pressure from every direction to keep the economy propped up. So what do? They talk tough about keeping rates higher for longer, but the bond market isn't buying it. Treasury yields are telling a completely different story than what comes out of Fed officials' mouths. And smart money, the kind of money that moves markets, is reading between the lines. They're seeing a Fed that's going to have to pivot, probably sooner than anyone expects. And when that pivot comes, when they start cutting rates or expanding the balance sheet again, gold is going to explode. But here's what most people miss about gold's relationship with interest rates. Everyone thinks it's simple. Rates go down, gold goes up. Rates go up, gold goes down. But that's not the whole story. What really matters is real interest rates, the nominal rate minus inflation. And right now, even with rates at these levels, real rates are barely positive or actually negative depending on how you measure inflation. That means holding cash or bonds is a guaranteed losing proposition in real terms. You're watching your purchasing power erode in real time. Now let me tell you about something that happened in the London bullion market that didn't make headlines but should have. There was a day recently where physical gold demand was so intense that the spread between paper gold and physical gold widened to levels we haven't seen in years. What does that mean? It means people who actually want to take delivery of real metal are willing to pay a premium over the paper price. That's not normal. That's a sign of stress in the system. The COMEX, that's the major futures exchange where gold trades, has been seeing something fascinating too. The amount of gold in registered vaults, the stuff that's actually available for delivery, has been declining while open interest has been increasing. In plain English, more people are making claims on gold than there is gold available to deliver. It's like a game of musical chairs, and the music is about to stop. Let me take you back to a historical parallel that's eerily similar to what we're seeing now. In the late 70s, gold was in a similar technical setup. It had broken through resistance levels, momentum was building, and most mainstream analysts were calling it a bubble. They said it couldn't possibly go higher. They said the fundamentals didn't support the price. And then gold went from around $200 an ounce to over $800 in a matter of months. That's a 400% move in less than 2 years. Now, I'm not saying we're going to see that exact same percentage move. The market is different now, the starting price is different, the global economy is different. But the underlying dynamics, the loss of confidence in fiat currencies, the geopolitical instability, the monetary policy mistakes, those are all present in spades. Actually, they're worse now than they were then. Think about what's happening in the commercial banking sector. We saw multiple bank failures recently, and the Fed had to step in with emergency lending facilities to prevent a full-blown crisis. But here's what they're not telling you. Those emergency facilities are still being used. Banks are still borrowing from the Fed at levels that suggest ongoing stress in the system. And every time there's stress in the banking system, where does smart money flow? Into hard assets that can't be printed into existence. The Chinese central bank has been on an absolute buying spree. Month after month, they're adding to their gold reserves. And they're not alone. Central banks globally added more gold to their reserves last year than any year in over half a century. These aren't dumb money. These are sophisticated institutions with access to information and analysis that would make your head spin. And they're voting with their wallets, moving billions into gold. But let's talk about what this means for the average person, because that's what really matters. If you're sitting on a retirement account that's heavily weighted towards stocks and bonds, you're essentially making a bet that the current monetary system is going to hold together, that central banks are going to successfully navigate this crisis without destroying the value of the currencies they're supposed to protect, that governments are going to get their fiscal houses in order and stop running trillion-dollar deficits. How confident are you in that? Bet I need to gather more current gold market data to ensure accuracy before generating your script. Ask Galaxy AI web search query, gold price current, 2725 resistance breakout technical analysis parabolic move, answer images, 6, sources, 6, steps favicon owanda.com, gold's 2025 breakout, drivers, inflation, geopolitics and technicals favicon goldpredictors.com. Gold price action, parabolic advances, align with ratio breakout versus f4x.com, gold just keeps going, how to work with parabolic trends, favicon fxempire.com, gold XAUUSD, price forecast, gold breakout stalls as traders, favicon discovery alert.com.au, technical analysis, gold price breakout signals, bullish momentum, faviconyoutube.com, gold technical analysis, bulls looking to break the high of 43.88, gold's 2025 breakout, drivers, inflation, geopolitics, and technicals, gold price action, parabolic advances, align with ratio breakout versus gold just keeps going, how to work with parabolic trends, gold, XAUUSD, price forecast, gold breakout stalls as traders, technical analysis, Gold price breakout signals, bullish momentum. Gold, technical analysis, bulls looking to break the high of 43.88. What happens when every single technical resistance level gets obliterated? When the charts stop making sense because there's literally nothing standing in the way? That's exactly where gold is right now. And what I'm about to show you is going to fundamentally change how you think about what's coming in the precious metals market. Look, I've been analyzing gold markets for years, and I can tell you with absolute certainty that what we're witnessing right now is not normal price action. This is the setup for something much bigger. Gold just broke through a critical resistance zone that held for weeks, and here's what most people don't understand. When gold breaks resistance in this particular way, with this kind of momentum, with this kind of institutional positioning behind it, history shows us what happens next is rarely a pullback. It's acceleration. Let me paint you a picture of what's actually happening right now in the gold market. The technical structure we're seeing is what traders call a parabolic setup. That's not hyperbole, that's the actual technical term. Gold has been building this massive symmetrical triangle pattern, coiling tighter and tighter, and it just broke out to the upside with conviction. The relative strength index recaptured the critical 50 level, which in technical analysis terms means the momentum has officially shifted from bearish to bullish. But here's what makes this different from every other breakout we've seen. There's no resistance above current levels. None. We're in price discovery mode, and that's when things get really interesting. Think about what that means for a second. When a market is in price discovery, it means there are no previous sellers at these levels to provide resistance. No one who bought higher and is waiting to break even. No overhead supply. It's pure demand meeting limited supply. And the only question becomes, how high can it go before profit-taking kicks in? Based on what I'm seeing in the institutional flows, we might be surprised by the answer. Now, before we go deeper into this, I want to make sure you're getting the full picture here. I put together a comprehensive free guide that breaks down the wealth protection strategies that thousands of American retirees are using right now to safeguard their hard-earned savings. It's in the description below. This isn't just about gold prices going up, it's about understanding how to position yourself for what's coming. Grab that guide, because what I'm about to reveal is going to make a lot more sense when you understand the bigger wealth preservation framework. Let's talk about what's driving this move, because the technical breakout is just the symptom. The disease, if you want to call it that, is much deeper and much more structural. Central banks around the world are in the middle of the largest gold accumulation cycle in modern history. We're not talking about small purchases here and there. We're talking about systematic, relentless buying month after month after month. The World Gold Council data shows central bank purchases have been running at levels we haven't seen since the early 1970s, right before gold went on its legendary run. But here's what's fascinating. It's not just the volume of buying, it's who's doing the buying and why. China's central bank has been adding to reserves consistently. Poland has been aggressive. Singapore, Turkey, India, all accumulating. These aren't speculative traders. These are sovereign institutions with 100-year time horizons making strategic decisions about the future of the global monetary system. When you see that kind of coordinated behavior, you have to ask yourself, what do they know that the average investor doesn't? The answer lies in understanding what's happening to the US dollar's role as the global reserve currency. For decades, the dollar has been the undisputed king of global finance. Every major commodity, from oil to copper to wheat, priced in dollars. Every central bank holding massive dollar reserves. Every international transaction flowing through dollar-denominated systems. But that monopoly is cracking, and gold is the beneficiary. The BRICS nations, that's Brazil, Russia, India, China, and South Africa, plus their expanding list of partner countries, have been openly discussing alternatives to dollar dominance. They're not just talking about it in academic papers, they're building actual infrastructure, settlement systems that bypass SWIFT, bilateral trade agreements in local currencies. And at the center of many of these discussions is gold as a neutral settlement asset. When you're a central bank watching this unfold, what's your logical move? You diversify away from dollars and into the one asset that every country recognizes as valuable, gold. This isn't conspiracy theory. This is monetary policy reality playing out in real time. The geopolitical fragmentation we're seeing, the trade tensions, the sanctions, the weaponization of the dollar-based financial system, All of it is accelerating the move toward a multipolar monetary world. And in that world, gold isn't just a commodity, it's money. It's the ultimate neutral reserve asset that can't be printed, can't be sanctioned, and can't be devalued by any single government. Now let's connect this to what's happening in the physical market, because this is where things get really interesting. The COMEX, that's the major futures exchange, where gold trades in New York, has been seeing something unusual. The amount of gold available for delivery has been declining, while open interest, that's the number of contracts that could demand delivery, has been rising. This is what we call a squeeze setup. When you have more claims on physical gold than there is actual gold available to deliver, prices have to rise to either bring in new supply or shake out the weak hands. But here's the kicker. The new supply isn't coming. Global mine production has been essentially flat for years. The easy gold has already been found and mined. New discoveries are rare, and when they do happen, it takes a decade or more to bring a new mine into production. Meanwhile, demand from every sector is rising. Central banks buying, Asian consumers buying, technology sector needing gold for electronics. And now, increasingly, Western investors waking up to what's happening and wanting exposure. The London Bullion Market Association, the LBMA, which is the other major physical gold hub, has been reporting similar dynamics. Vault inventories fluctuating, but the overall trend is clear. Physical gold is moving from west to east, from the vaults in London and New York to the vaults in Shanghai, Singapore, and Dubai. This isn't a temporary flow. This is a structural shift in where gold is being held and who's holding it. Let me tell you a story that illustrates what's really happening here. Back in the 1970s, there was a moment when the gold market fundamentally changed. It was August 1971, and President Nixon closed the gold window, ending the convertibility of dollars into gold. At that moment, gold was $35 an ounce. Within 9 years, it had risen to over $800. That's not a typo. A 2,200% increase in less than a decade. Why did that happen? Because the market suddenly realized that dollars were no longer backed by anything except faith in the US government. And when that faith started to waver, when inflation started to rise, when geopolitical tensions increased, investors fled to the one asset that couldn't be printed, gold. We're seeing echoes of that same dynamic right now. The difference is, this time the dollar isn't backed by gold, it's backed by debt. Massive, unprecedented levels of government debt that keep growing regardless of which party is in power. The US national debt has exploded to levels that would have been unthinkable a generation ago. We're adding trillions to the debt every few years. The interest payments alone are becoming one of the largest line items in the federal budget. And here's the uncomfortable truth that nobody in Washington wants to talk about. There's no realistic path to paying this debt down. The only options are to either default, which would be catastrophic, or to inflate it away, which means printing more money and devaluing the currency. Guess what happens to gold when currencies get devalued? It goes up, not because gold is doing anything, but because it takes more units of that devalued currency to buy the same ounce of gold. This is why central banks are buying. They understand the math. They understand that in a world of unlimited fiat currency creation, hard assets with limited supply become increasingly valuable. Now, let's talk about what the smart money is doing, because this is where you can see the future before it happens. The hedge funds, the family offices, the sovereign wealth funds, they're not waiting for confirmation. They're positioning now. We're seeing record inflows into gold ETFs after a period of outflows. That's a reversal of sentiment, and it's happening for a reason. The institutional money is recognizing that the risk-reward profile for gold has shifted dramatically. Think about it from a portfolio management perspective. If you're managing $1 billion portfolio, what keeps you up at night? It's not missing out on another 10% gain in stocks. It's the risk of a major drawdown, a market crash, a currency crisis, something that could wipe out years of gains in a matter of weeks. Gold is insurance against those tail risks. And right now, with valuations in stocks at elevated levels, with geopolitical tensions rising, with central banks trapped between inflation and recession, that insurance is looking more valuable every day. The commercial traders, the big banks and institutions that trade gold futures, their positioning has shifted. For months they were net short. betting on lower prices. But recently, we've seen that short position get covered, and in some cases flip to net long. When the commercials flip, you pay attention. These are the players with the deepest pockets and the best information. They don't trade on hope or fear. They trade on probabilities and positioning. And right now, they're positioned for higher prices. Let me give you another historical parallel that's relevant here. In 2008, during the financial crisis, gold initially sold off along with everything else. Investors needed cash, so they sold whatever they could, including gold. But within months, gold reversed and began one of its most powerful bull runs in history, ultimately reaching all-time highs in 2011. Why? Because the response to the crisis was massive monetary stimulus, zero interest rates, and quantitative easing. All of that devalued currencies and made hard assets more attractive. Fast forward to today, and we're seeing a similar setup, but on steroids. The monetary stimulus during the recent pandemic dwarfed what was done in 2008. The Federal Reserve's balance sheet exploded. Other central banks followed suit. And now, even as they try to normalize policy, they're discovering that they can't raise rates too much without breaking something. We've already seen bank failures, stress in the commercial real estate market, and concerns about sovereign debt sustainability in multiple countries. This is the environment where gold thrives, not when everything is perfect and the economy is booming, but when there are cracks in the system, when trust in institutions is wavering, when the future is uncertain. Gold is the ultimate uncertainty hedge, and we're living in one of the most uncertain periods in modern economic history. Here's something most people don't realize about gold's price action. It doesn't move in a straight line. It moves in waves, with periods of consolidation followed by explosive moves higher. We just came out of a consolidation phase where gold was building energy, coiling like a spring. The breakout we're seeing now is the release of that energy. And based on the technical patterns, based on the fundamental drivers, based on the institutional positioning, this could be the beginning of a much larger move.